So with yields having normalized, investing has actually gotten easier. So at one point during 2022, the 10-year Treasury was below 40 basis points or 0.4%. So you would look at that component of the portfolio and you really, mathematically, there was not a lot of earnings or growth potential associated with that. Well, now rates have, I'd say, entered somewhat of a normal zone. If you go back to 1870, over 60% of the time, the 10-year Treasury is somewhere between 3 to 6%, and I'd say on average call it 4.5. So kind of where we are today is not that different than where you usually are. And yet, because we've all been conditioned to zero interest rate policy and incredibly low rates, this looks pretty incredible. And so, obviously there's a lot of other types of bond sectors, and so you can look at things like investment grade corporate bonds and get something even approaching like 6%, or you can even step further into risk, whether it's in high yield or in senior loans, and get 9, 10%. And so another often used mantra during the bull market run-up was this cute acronym, TINA. There is no alternative. Well, I tell you today, there's a pretty good alternative. A bird in hand, call it 6%, investment grade corporate bond, is a good alternative. Particularly, again, when inflation is on the decline, you're earning a positive real rate. And so what's interesting and why I said it's a lot easier to be an investor today, if you go back through time and you think about where rates were, and again, rates have sort of been on a decline ever since the early 80s. So if you go back into the 80s or even early 90s, you could build a portfolio to generate a 7% return with 80 to 90% in bonds. And then kind of as you progressed, as yields continued to fall, investors had to take on more and more risk, take on more and more stock exposure to get the same 7% rate of return. And in 2022, when I mentioned bond rates sort of hit the floor, you essentially had to be all in stocks, maybe a handful of bonds to generate that same 7% return. Well, today, as we look forward and what we believe capital markets will produce, both in the stock and bond market, I think you're back to where you could have half your portfolio in fixed income and still get that 7%. So there is an alternative, and it's a great opportunity for investors to reassess their portfolios and consider de-risking, because if the goal was 7% or 8%, whatever the number was, you could probably get there with a lot less risk today, certainly than you could have in 2022.